Hey YouTube, welcome to my 5 golden rules video for selling options. These rules will help protect you from yourself and ideally help you make good trading decisions throughout your trading career. The 5 golden rules are: number 1, sell options on stocks you're happy to own. Number 2, never panic, especially during after hours trading. Number 3, stocks don't only go down or only go up. Have patience. Number 4, don't overextend. Max trade size of 10%, max position size of 20%. And number 5, always take profit. So that's it. Those are the 5 golden rules. If that's all you wanted to hear, you're free to leave. Otherwise, I'll dive into what I mean by each of these one by one. So the first rule is to sell options on stocks that you like. And I have a great example for you. So Reddit is a stock that has a colorful story. And personally, I've owned this stock from the 40s down here up until 230 up here, back down to 80, and then back up to 285, back down to 200, and probably back to 300 here in the not too distant future. Not financial advice, do your own due diligence, all that fun stuff. You can ignore all of my drawings here, but basically what I mean by this is there were times where you are going to question your conviction when your stock does something like this, right? Where it drops basically 50%, if not more. I mean, from the highs, it was down more than 50%. But I have a long-term conviction in this stock. So for me, it was an opportunity to get more shares at a cheaper price than I could otherwise ever get. And I'm not sure I'll ever get shares at this price again. So I took it as an opportunity to sell CSPs on the way down, collecting more and more shares down here in the low 100s and 80s even, where when we rode back up, it was fantastic. And I ended up being very happy that I held on. But at the end of the day, if you're not really happy with the stock, when you're selling options and this happens, you're going to realize like, oh, I didn't like the stock that much. However, I love this stock. So despite being dismayed at times, I held strong and was like, nah, it's going to come back. I don't know. I don't even know why it's dropping like this. Nobody could tell you why. And here we are, right? So again, very messy with all these drawings on it. Sorry about that. But let's get to rule number 2. Rule number 2, never panic, especially during after hours trading. So it's very common that you're going to run into a situation where earnings look maybe terrible or great. You're going to inevitably be holding stocks over time periods where the market isn't open for managing options. Anything after hours and pre-market especially can cause these type of situations. But one thing you need to know is there are going to be times where it looks like shares are going to get called away. And we're going to use HIMS as my example for this one, which is a stock that is just very volatile and all over the place. So again, this time I'll actually shut off some of the different shapes. And in this chart, you can see that the stock during this particular period over here was very wild. Now, what does this mean to anyone? Well, it doesn't probably mean much to you unless you were actually in it and selling options on it like I was. And I can tell you that this was a Friday, right? And I sold options on maybe it was Monday over here or Tuesday for covered calls. And I was like, oh man, they're going to get called away at 56. This is amazing. And then it dropped. Now what do you do? Well, the answer is nothing. You could buy this back if you wanted. The next week, I did the same thing. And I think maybe I sold it here, same thing, $56 for a covered call. And it spiked up to 59. And a lot of people would go like, oh no, your shares are going to get called away. Well, the fact is, I was fine with that. And that was the preference because that was above my cost basis. And then look what happened on Friday. Vroom, all the way back down to 54, out of the money. And guess what? It happened again the next week where I sold covered calls for 56, literally the same option week after week after week. And I was pretty happy with the premium. My cost basis was 52 at the time, right? And look what happened. We spiked up to 65 almost. I think, we did hit 65. And then by the time we got to Friday, we finished under 50. But during this time, a lot of people panicked where they're like, hey, my shares are going to get called away. I don't want them to get called away, which I disagree with anyway because you're getting max profit if you're selling covered calls on them. But number two, we never know what's going to happen. And now we're down here, but again, there's really no reason to panic. Now, there could be something macroeconomic happening, but sometimes this is just how stocks move. So more often than not, just having patience is the answer. In terms of not selling options and just buying shares, here's a great example though where people were seeing this spike up and they were FOMOing in. Then we saw this result where people were panic selling. These two things in 1 week, we experienced both FOMO and panic. That's the nature of the market, especially on these more volatile tickers that have really nice premiums. So if you like the stock and you're happy to own it, as in rule number one, that can help you get through rule number two of not panic buying or panic selling. Just play the flat, easy game. If we wanted to draw a line right through the middle here of a trend line, it's probably something like that. I'm sure there's a better trend line than what I just drew, but you get the picture of not much really change materially across the average there. Rule number three, stocks don't only go up or only go down. And for this example, I have a favorite of a lot of people, ASTS. Now, there was a huge run up here from 36 to 102. And a lot of people were like, oh man, I really wish that I got into ASTS. And my answer to them was like, well, just wait. You'll probably get an opportunity because this is a wild run. And what did we do? We back tested the 66. And by the way, this isn't the first time this happened, right? We ran up from 23 to 60, but back down to 35, right? So yes, the trend is up, and for sure, you may never get this opportunity to buy back down to 20. But at the end of the day, stocks tend to revert to the mean or back test. That's why we have technical analysis of things like EMAs, SMAs, the fib lines, things like that. But even when we went down and we were dropping quickly, I think a lot of people were panic selling here as well, going like, oh my God, it's going all the way back to 35. No, I mean, over time, what we hope to see on a stock is that I'll draw another trend line. Let me take out this other one here of up and to the right. And look at that. That's kind of what it's doing, right? So as things are going up, and this is across days. Now, you can look at weeks as well to maybe feel a little bit better or worse, depending on how you're looking at it, of the longer time frame, right? It smooths things out quite a bit. And that's, again, that's what we're looking at here with a lot of these EMAs and SMAs. So no, they don't only go up. Don't buy at extreme peak highs that you're like, we were at all-time highs. That's where I go, have some patience. It'll probably come back. And if it's a stock you really like, well, buying it somewhere on this trend line should be good. Even if it goes below it, and guess what? We're heading right back to it. Number four, don't overextend. Have some max position sizing rules. Now, not everybody is going to have the same rules, and my rules may not be right for you. This is an example from a friend on After Hour, Ferrari Fund, who has put this together, and I like it. I think this is a really good representation of average conviction considerations to make. And it isn't really based on math. It's based on gut feel, because at the end of the day, gut feel is very important. If you don't feel well during your trades, what does the math matter? Life's not worth stressing all day about numbers. So what I like to do is I look at this. If you have low conviction on a stock, size it appropriately. Only put 1 to 2% of your port. And if it doesn't fit because it's too expensive a stock, don't play it. Because if you play a stock that you have low conviction on, but it takes 30% of your port, you're going to realize that you have low conviction on it when you're sick to your stomach when it moves against you. Then you've got medium conviction. Medium conviction is a stock that you kind of like and you think there's some real good potential here. Okay, well maybe you go to 5% on position sizing. Now, this is where it gets very interesting. See how these have a range of 1 to 2, 5 to 10, etc., 10 to 20, 15 to 20. This is where your individual trade size should be that smaller number or less. It's okay to stagger your sells because by doing that, you protect yourself. Now, if you sell options of 5% on a medium conviction stock and it drops significantly, but you still have conviction, now you have space to get more contracts, potentially more than double, depending on how much it dropped, And by doing that, even though you'll get assigned potentially on one, if not both, you're lowering your cost basis even further than you would have done if you didn't size it appropriately. Now, if you went full load on that 10%, well, you might feel stuck. And that's when you get into these bag holding situations and you don't feel like you can adjust up or down on it. Now, I love doing these where maybe if instead of 5%, I do 2.5% position size. And that gives you a ton of space. This also depends on how actively you're managing things, because if you don't have time or you don't want to manage it, well, then adjust your conviction and rule sizing and position sizing based on all of the above there. Now, there are max position sizes that I have of, I agree with, I have a 25, if not 30% position in one stock. And I don't even want to tell you what it is, but you can probably guess by now that it's Reddit. So if you want to really go heavy in one position, that's fine. Just know that that's going to feel very heavy at times when the stock has unfavorable movement, because stocks don't only go up or only go down. Rule number 5, the final rule of always take profit. This is a great example of, and you'll experience this no matter what, of kicking yourself when you didn't close an option that was at like 90% profit, and then you miss the opportunity to redeploy that capital elsewhere for another opportunity, or whatever, resell it. So I have an example up here on my screen, which I'll zoom in a little bit. And the example is CoreWeave, where CoreWeave is a company that in September, I was reselling this repeatedly, buying back and reselling. So there are times where you might see 55% in this exact example in a day, and then you can resell it later in the week, where I could have made $1,800 in the trade immediately, but instead I ended up being able to make almost $2,500 when you combine these couple of trades. So if we were to do the math real quickly here, 2,500 divided by 1884 is a 32% improvement from where we would have been otherwise on the same money. So we could do the calculation of how that improved the ROI and all that, but the fact is our ROI improved by another 30%. And that's exciting because that's a material number, especially if you do that over the course of a year. Sometimes I like to call that juicing, depending on how you do it. And you don't always get the opportunity to resell the same exact company, but you can redeploy that money. Now, this is especially true on cash secured puts, where you're given cash back that's now free to be used on anything, full flexibility. If you were to look at that on the covered call size, it's a little bit different math because you can't necessarily always redeploy on the same exact covered call. So the general rule of thumb is anytime you're about 50% in profit before 50% of time has elapsed, meaning you're ahead of that theta curve, it's a good idea to buy to close, especially on the CSPs. But on the covered call side, the math changes a little bit because you can't always redeploy that. However, what you can do is look further out for maybe the next week's expiration, things like that. So something to consider, but not a hard and fast rule. You need to figure out what you're most comfortable with because it does, again, take more management of this as well. Now, a little trick that I use on occasion is on a Monday, let's say I sell a cash secured put for whatever, this CoreWeave of 315 for a contract. I might go in and set a limit buy to close for $1.50. And on Wednesday, if it hasn't hit, I'll cancel it out. But if it has, great, now I can resell whenever I'd like. The last thing to think about on the cash secured put side is if you're at like 80% profit or better, keep in mind that things can go awry. So looking at the HIMSS chart again, if you were selling a cash secured put here instead of a covered call and you sold it at 52, and guess what? On Wednesday, it went to 65. 100% you should be buying to close this because that is, again, freeing up definitely more than 50% of cash. And if you look at where things ended on Friday, you would have actually been underwater potentially. I think it's unlikely you would have gotten better premium to protect yourself down to 49. So in this case, which is random, it would have been much better to have bought this back in profit at high profit and then potentially resell a CSP here down in the 40s. And that's it. That's it for my golden rules. Hopefully that helped you maybe come up with some better rules or considerations that you might think about before making any panic moves. This is all about psychology at the end of the day, managing yourself, managing your own emotions, and developing the discipline to keep a consistent trading mindset throughout any market situation. I hope this helps, and I'll see you in the next video. Take care.